to the folks that are writing their 2026 outlooks and maybe get a sense of where we go.
Reset, reassess.
Yep.
Yeah.
Absolutely. So we're going to do that strong here, right here at the top of the 9 o'clock hour with our next guest, Shana Sissel, founder and CEO of Banríon Capital Management. She could talk about anything across the markets, but Banríon, they focus on alternative investments. And I've been amazed really over the last 5, 6, 7 years how much the allocation to alternatives, even for just, RIAs, has really ramped up over the years. It's become a big part of a lot of people's portfolios, a lot of institutions' portfolios. And it's not just private equity, it's private credit, it's hedge funds, it's all types of real assets, all that type of stuff. And that's where Shana and her firm really focus. Shana, talk to us about kind of your positioning for alternatives in 2026. What kind of role do you think they will play with your clients' portfolios?
I think they'll play a huge role. You said that there's been a ramp up, and there has. We've seen $2.7 trillion into the space, and they expect that to double in the next 5 years. So it's not a small amount of money, but as a percentage of client portfolios, it's still not huge. The vast majority of REAs aren't using alternatives. And I think that's really going to change as we go into the next year or next 2 years. As more and more advisors become more educated, better product comes out into the market, the rise of interval funds is a big part of that. And just understanding the role that they play, I think in 2026 specifically, we'll see more hedge fund-like strategies. Private credit has been all the rage for 2025. But as volatility rises, you want to have things that are going to help manage the risk of volatility. And that's going to be in what I like to call that diversifier bucket, which is hedge funds and hedge fund-like strategies. So there's plenty of ETFs out there and mutual funds that fall into this space, things that are doing equity long short, equity market neutral, any sort of distressed securities, anything event driven, things of that nature. Managed futures fall into this bucket, global macro. These are things that there's an arbitrage opportunity and there's a long and a short side of the book. So there's a risk management opportunity there. And the use of leverage will really be based on, the vehicle that's chosen by the advisor and their client to allocate to. ETFs and mutual funds have low leverage. As you get into more of the private placements, the hedge funds, where they can use leverage and differently, you'll see leverage being used there. And then the one other thing I want you to pay attention to in 2026 is the idea of return stacking. It's all the rage. You're seeing it everywhere. Yesterday, you saw quantify funds open. I think it was the NYSE. These return stackings is the idea of using leverage to get the 90-60, as they call it. It's a traditional 60-40, and then the use of leverage to get another 20 to 30% into like a managed futures or something like that. You're going to see Wisdom Tree launching something like that. Corey Hoffstein's Newfound Research has a suite of ETFs that are doing this. Banríon has a client, Rare View Capital, that has an ETF called BEGS that does this. It's this idea of using leverage strategically to increase your exposure to alternatives without giving up the exposure to your traditional 60-40.
Shana, you mentioned interval funds, and I've heard that a lot more recently. Can you explain what those are?
So interval funds are available to any type of investor. So they don't have an accredited investor hurdle, which has been the biggest reason why you haven't seen mass adoption of alternatives in the past, is that almost all alternatives have an accredited investor hurdle, meaning you have to meet certain criteria that are set out by the SEC, usually have income of $250,000 or more for a certain number of years, and a net worth over $1 million. And so unless you met that hurdle, you couldn't invest in these products. Interval funds remove that hurdle. Think of them as sort of if closed-end funds and mutual funds had a baby. So there's a lot of similarities to both in that, like mutual funds, they strike a NAV based on the underlying holdings, not on market movement. But like closed-end funds, they don't trade They're not all that liquid. In the case of interval funds, they have quarterly redemption periods. So they are able to give exposure to things that are less liquid because they don't have daily liquidity. So you get private credit, private equity, and things of that nature in interval fund form, which is something that really wasn't available before. And so that's why the vast majority of investors out there, no matter who you are, you can gain exposure. Interval funds have minimums as little as $2,500.
Wow. All right. Did not I learned something new today?
I know. I'm telling you, I always learn
Shana,
something.
what are your thoughts on ETFs? I know this is a broad ranging. I mean, there are lots of ETFs to choose from, but I mean, ETF inflows just shattered records this year. 1.4 trillion in the U.S. And there's still a few days left to go in the year. So your take on ETFs, and maybe are we going to see a little bit of a pullback in those inflows in the new year?
Well, I think we've seen a lot of new product. In fact, speaking of alternatives, it was a record year for leveraged ETFs this year, and that is something worth noting. I think you're seeing it because they're a more tax efficient vehicle. A lot of firms are converting mutual funds into ETF form, but I think we'll really see mass inflows into ETFs if and when they ever become available in 401k plans. 401k plans have almost always exclusively been mutual funds. The only way you could buy ETFs in a 401k plan is if your plan included a self-directed brokerage option, which most don't. But if ETFs ever became available in 401k plans, I think that would be the death knell in mutual funds. Everybody would switch to ETFs. They're just cheaper and they're more tax efficient. And I think that's why you see more and more people moving to that. And I think that's why you see more and more firms converting their mutual funds into ETFs. And then the new ruling by the SEC allows for mutual funds to have ETF share classes, which is different than it was before. Before you had to convert the entire mutual fund to an ETF. Now you don't. Now you can just hang ETF share class off an existing mutual fund, which I think is an interesting development, which will only continue to see
dual class,
money
dual
moving
class
to ETFs.
share for ETFs, right?
Yep,
The dual class.
exactly.
Has that taken effect already, or is that in the new year?
I think it's in the new year,
Yeah,
but
I
I
think you're
don't
right.
know exactly. I haven't read, it's been a while since I read that article, but it was a fairly significant piece of news that happened in like the last 60 days.
Shana, just before we let you go, I grew up as a sell-side analyst, and the big mutual funds, those were the biggest and best clients in the world. But what's the future of the mutual fund business?
Well, I think the future of the mutual fund business is mutual funds will exist where mutual funds as a form, as a structure, make the most sense. Things that require the ability to close a fund, like small caps, micro caps, things of that nature, where having a fund that capacity could be an issue, is not really going to work well in an ETF. I don't know that it necessarily changes anything, though, because active ETFs are a thing.
Yep.
And they're still going to be the best clients of the sell side guys. It's just a different structure. And with the daily liquidity and the create redemption process, which is a completely different conversation we'll save for another day. I think that it doesn't change the potential opportunities between the sell side and the buy side.
It's crazy.
Just changes the structure.
Yep, absolutely. All right, Shana, thanks so much for joining us. Appreciate always getting a few minutes of your time. Shana Sissel, founder and CEO.